hope you had a great lunch. I hope you had a great conversation. I hope you have great questions for Deputy Governor Gravelle. Greetings like this, where financial sector leaders come together, are essential for steering through our rapidly changing economic landscape, and it's this very pace of change that makes today's speaker especially important. Toni Gravelle became Deputy Governor of the Bank of Canada in October 2019. In his role, he oversees the bank's financial system activities and shares responsibility for setting monetary policy. Mr. Gravelle first joined the bank, I learned a lot of this as we had lunch together, as an analyst in 1996, shortly after graduating university, getting married, and moving to Ottawa, and went on to hold various positions within the Financial Markets Department, becoming Managing Director in 2015. In addition to his extensive research experience at the bank, Mr. Gravelle served as General Director of the Financial Sector Policy Branch at the Canadian Department of Finance from 2013 to 2015, and was an economist at the IMF from 2002 to 2005. Mr. Gravelle is a native of Corbeil, Ontario, and holds a PhD in economics from Western University. Please join me in welcoming Deputy Governor Toni Gravelle to the podium. Bold move to step on the stage.
Excuse me. Wow, lots of mics. I'm mic'd up here too. Well, thanks, Tanya, for that kind introduction. And I got to unlock my iPad. And thanks to Versify for hosting this event. Yeah, we were talking about my background at lunch. And as Tanya mentioned, I graduated, got married, moved to Ottawa, and started a new job in 2 months. That was my wife's doing. She's very organized, and I thank her for it. So the Bank of Canada's balance sheet has been larger than normal for a few years now. That's because of the role it played during the COVID-19 crisis in making sure financial markets worked properly and in setting the economy on a path to recovery. As we began to emerge from the worst of the pandemic, we ended quantitative easing, or QE, in October 2021. 6 months later, in April 2022, we started shrinking the balance sheet through quantitative tightening, or QT, a process that continues today. Under QT, I'm going to have to pronounce the T's and E's really precisely, we have been letting our bond holdings roll off as they mature. Last year, I said we thought that QT, also known as balance sheet normalization, would end sometime in 2025. Well, it's 2025. I should have wished you a Happy New Year, I guess. So, since I promised to provide any news about QT ahead of time, that's why I'm here today. When QT ends, we'll be back to business as usual for how we manage our balance sheet. This will look a lot like how we manage our balance sheet before the pandemic, which I outlined in a speech last March. Essentially, we'll be purchasing assets mainly to offset the growth of currency in circulation, that is, the growth of cash in your wallets, what everybody has in their wallets. But some things have changed in the 5 years since the start of the pandemic. In particular, the payment system has evolved, and so has our monetary policy implementation framework. As a result, some evolution of how we manage our balance sheet is needed. So today I'll give you an update on 3 things. 1, when we expect QT to end. 2, how we will manage our balance sheet after QT ends and have resumed our business as usual asset purchases. And 3, what the likely drivers are of recent pressures in overnight funding markets. Let me start with a bit of background about a crucial element of our balance sheet, one that is key to guiding our QT process. I'm talking about settlement balances, what most other jurisdictions call central bank reserves. Like currency, these reserves represent a liability on our balance sheet. Specifically, reserves are interest-bearing deposits held at the Bank of Canada that belong to members of Lynx, Canada's high-value wholesale payment system. They include the biggest banks, which process the bulk of payments in Canada, and as a result, hold most of the reserves. The interest rate we pay on these reserves is called a deposit rate. And due to arbitrage in overnight funding markets, the rate for the overnight repurchases or repo agreements tends to be at or close to our deposit rate. And since the deposit rate moves one for one with our policy rate, this helps ensure that the one-day or overnight market rate is also close to or at our policy rate. When we change our policy rate, this implies an equivalent change in the deposit rate. This leads to changes in the overnight rate and, in turn, changes in longer-term interest rates, such as business loan and mortgage rates. This is how we implement monetary policy and how we ensure that it is reflected in borrowing and lending rates throughout the economy. Now, because we now operate in a floor system, our aim in steady state is to supply just enough settlement balances or reserves to satisfy the demand from banks and other LINKS participants. Currently, though, the amount of reserves on our books is higher than our estimate of that demand. So we shrink our balance sheet through QT. We are lowering the supply of reserves towards our best estimate of the demand for them. This lower level is really a range because we use a few different approaches to estimating the demand for reserves. In estimating the overall demand for reserves in the financial system, we look at two types of demand. The first is payments-driven demand, which is the amount needed for Canada's high-value payment system to operate smoothly. In other words, the amount of reserves that LINKS members want to keep on hand so that they can settle daily payments with each other. The second type is precautionary demand. What do I mean by precautionary demand? Well, basically, you can think of precautionary demand as similar to the buffer you might hold in your checking account for unexpected expenses that might come up. In the case of financial institutions, this precautionary buffer is typically made out of risk-free liquid assets, such as Government of Canada bonds or reserves. And these are held for unexpected funding and liquidity shocks. But measuring either payments or precaution-driven demand for reserves is difficult. So to come up with the best estimate that we can, we regularly survey banks and other LINKS participants to help us understand how much demand there is out there. And in the latter part of 2024, we determined from these discussions and our subsequent analysis that reserve demand had grown beyond the level that we had previously estimated. In early 2024, we thought QT would end when the level of reserves declined to $20 to $60 billion. Due to the updated assessment of demand, we have revised that range upward to between $50 and $70 billion range. For context, we currently have about $130 billion of reserves on our balance sheet, which is down from a peak of roughly $400 billion during the pandemic. As you can see from the chart over there, we expect the supply of settlement balances or reserves to reach our new estimated range for demand around mid-year. So on the chart, you see that we've plotted the supply of reserves, both in a historical context and our forecast for the supply of reserves. And the shaded area is basically the new estimated range, which is $50 to $70 billion. And the dashed green line is a forecast that assumes that the government deposits with us at the Bank of Canada remain constant. So you can see the dashed green line crosses through the shaded area, which is the estimated demand, sometime in mid-2025. Based on the maturity profile of our assets, the supply of settlement balances is expected to fall well below the $50 to $70 billion range in the third quarter of this year, which you can see on the chart. So as you can see on this next chart, that's because of a very large Government of Canada bond maturity coming due on September 1st. So this chart plots the maturity profile of our assets up to 2030, and that September 1st maturity is that very tallest bar towards the left, which is around 26 billion. To achieve a smooth glide path for the supply of reserves to land within the estimated demand range, we will need a transition process where we undertake asset purchases in order to help offset that sharp drop. That means we will need to restart our normal course asset purchases ahead of that September maturity. So this brings me to what you're likely keen to find out. When will we end QT? The answer is coming right up. I'll hold on for a bit just so you guys can scream. As a result of our bond holdings maturity profile and the need for that smooth transition process, we expect to announce the end of QT and the associated restart of our business-as-usual asset purchases in the first half of this year. I'll repeat, we expect to end QT in the first half of this year. When we make that announcement, we will also publish a market notice with more details about the asset acquisition process, including the timing of our initial purchases and expected amounts. Given this timeline, I expect we will be the first central bank, or among the first central banks, to finish shrinking its pandemic-related QE asset holdings. This reflects three considerations. First, going into the pandemic, our balance sheet was smaller relative to other central bank balance sheets because we hadn't undertaken QE before. Second, we ended QE earlier than others. And third, the maturity profile of our assets coming out of our COVID actions was shorter, so QT has gone faster in Canada than in most other jurisdictions. As you can see from this chart, this last chart, no more charts, in terms of assets as a share of nominal GDP, our balance sheet is already smaller than those other major jurisdictions that you can see from the red line, which is our balance sheet. It's also smaller than Sweden and the balance sheet of the Swedish and UK central bank, even though they have undertaken a more proactive QT process of selling their assets, their QE assets. Once we resume purchasing assets, we will aim to manage our balance sheet in a way that keeps the level of reserves in that $50 to $70 billion range. I want to stress that over the longer term, demand for reserves will continue to evolve as the financial system evolves. So the amount of reserves that major banks and other LINX participants want to hold will likely vary as well over the long term. This means we will likely adjust our estimated range from time to time, up or down, to reflect changes in that demand for central bank reserves. That way we can make sure that our framework for implementing monetary policy remains effective. Okay, so what will business as usual balance sheet management look like after QT ends? Under normal course of balance sheet management, we buy assets on a passive basis to reflect the autonomous rise of our liabilities. Traditionally, the biggest liability has been currency in circulation, or cash. Consumer and business demand for cash usually grows at roughly the same speed as nominal GDP growth. I want to be clear, though, that while QT is almost finished, the composition of our asset holdings won't be back to normal for quite some time. As I explained last March, we want to restore a more balanced mix of assets with a broader range of maturities, including in particular shorter-term assets than we hold now. Currently, our asset portfolio is made up almost entirely of Government of Canada or GUC bonds. You can think of that as our QE legacy asset holdings. As a result, our asset holdings have a maturity profile that skews longer than it did before the pandemic. Going forward, we'll hold not only Government of Canada bonds, but also Government of Canada Treasury bills or T-bills and term repos, just as we did before the pandemic. In steady state, we will aim to have the amount of our floating rate assets, mostly term repos and T-bills, match the amount of our floating rate liabilities, which include our reserves. And we will aim to have the size of our bond holdings roughly match currency in circulation, given that currency is assumed to be a permanent liability. Although our asset purchase plan will be designed to ramp up towards that steady state composition, our asset growth is limited by the growth in currency in circulation. So we may not reach that steady state asset composition until almost or around 2030, depending on how quickly the currency grows. I want to emphasize that we will not be buying assets on an active basis to stimulate the economy like we did during the pandemic when we were doing QE. Our normal asset purchases before the pandemic were not QE. Our normal course asset purchases after QT ends will not be QE either. Try saying that 10 times fast. Okay, let's get into some of the specifics of our asset acquisition plan. When we start growing our assets again for business as usual balance sheet management purposes, we will start with term repos. These will be for 1 and 3 month terms and will likely gradually ramp up the amounts through biweekly operations. We expect T-bill purchases to resume in the fourth quarter of this year, initially for relatively small amounts. They will be purchased via primary markets, that is, via GOC T-bill auctions. As for Government of Canada bond purchases, these will likely not start until the end of 2026 at its earliest. Rest assured, when we get closer to purchasing bonds, we will announce the timing and other details well ahead of time. But when we start buying GOC bonds again, we will do so in the secondary market. Secondary market purchases align with benchmark practices of other central banks, and there are advantages to doing it this way compared to buying bonds in the primary market, which was our practice before the pandemic. One advantage is that secondary market purchases will give us the flexibility to buy any of the GOC bonds outstanding across the full spectrum of maturities, rather than being limited to what's on offer at individual Government of Canada bond auctions. This will allow us to replace maturing bonds with bonds from the maturity buckets that we want, which will allow us to rebalance the maturity structure of our asset holdings more quickly towards that sort of shorter duration composition. Another advantage is that buying in the secondary market also helps enhance Government of Canada bond market functioning and liquidity. It gives participants more regular opportunities to trade and see pricing points for off-the-run bonds that are less liquid than the on-the-run bonds. When we do become regular buyers of these markets again, a couple key principles will guide us to help ensure that our presence leans towards enhancing market functioning. First and foremost, we want to limit the market impact of our purchase operations. Our bond purchase operations, for example, will be price sensitive, and we won't necessarily buy everything that the dealers offer to us. And second, we will always aim to be as transparent, as predictable as possible. Okay, so now you know what comes next after QT ends. Before I conclude, let me also take this opportunity to say a few words about the recent pressures in repo markets. I want to be clear that we will not be ending QT out of any concern about the functioning of repo markets. I also want to be very clear that the pressures in repo markets are not a reflection or an indication of broader financial system stress. Like I mentioned last year, and as we determined again through more recent monitoring and analysis, hedge fund activity and positioning have been contributing to higher funding requirements in the repo market. This, along with other factors, such as the transition to a one-day settlement period for trades, also known as T+1 settlement, has led to upward pressure on overnight repo rates. As always, we will continue to monitor all these repo market dynamics. Okay, I guess people have munched away at some of the dessert, so it's probably time for me to wrap up. It's been a long road, almost 3 years since we began QT. But we have just about finished the QT process and the unwind of our COVID-related asset holdings. We will announce the end of QT in the first half of this year, and we will restart some of our normal course asset purchases after it ends. When QT is done, we'll go back to managing the balance sheet in a way that looks a lot like how we managed it before the pandemic. Crucially, we'll restart buying assets. When we restart buying assets, these will be normal passive purchases reflecting the growth of currency in circulation and not QE. I'm going to say a few words in French for the benefit of our French speakers on our web audience, and then repeat those same messages in English. Comme le système financier a évolué, notre approche de la gestion du bilan a aussi évolué. Ce changement est reflété dans le fait que nous sommes passés à un système de valeurs plancher pour l'implantation de notre politique monétaire. Cela nous oblige à fournir un montant de solde de règlement correspondant à peu près à leur demande. Or, nous estimons maintenant que cette demande est plus élevée que ce que nous avions projeté l'an passé quand j'ai parlé de notre processus de resserrement quantitatif. À plus longue échéance, puisque le système financier continuera d'évoluer, il faut s'attendre à ce que la demande de solde de règlement évolue également. Les participants au marché peuvent compter sur nous pour communiquer clairement et à l'avance les prochaines mesures que nous prendrons. Et la population peut compter sur nous pour gérer notre bilan de manière qui nous permet à la fois de remplir notre mandat de politique monétaire et de promouvoir la stabilité et l'efficience du système financier. Because the broader financial system has evolved, our approach to balance sheet management has also evolved. This is reflected in our shift to our floor system for implementing our monetary policy, which means we need to supply an amount of settlement balances or reserves that roughly matches that of the demand for them. And the demand is now estimated to be higher than where we thought it would be when I spoke about our QT process last year. Over the longer term, since the financial system will continue to evolve, you can expect that the demand for settlement balances will also evolve as well. Market participants can count on us to communicate our next steps clearly and ahead of time. And Canadians can count on us to manage our balance sheet in a way that both lets us achieve our monetary policy objectives and promote a stable and efficient financial system. Well, with that, thank you, and I'm happy to take questions.
Everybody for questions. I will encourage you to continue to write them down. We're happy to take them. We've got actually a good number here, but if you have things that come up. Tony, thank you very much. Okay, we've got some good stuff from the audience here. So I will probably kind of scope up 50,000 feet, go back down, but in no certain order. I like to start where it's spiciest. If a trade war began between the US and Canada, will the bank think about QE as a support mechanism?
Well, I'll start by saying, of course, a trade war or tariffs would be hard on the Canadian economy. Of course, we've been sharpening our pencils. We've been doing a lot of analysis, and you'll see a lot of that analysis in our NPR that's coming out in a couple of weeks. Nonetheless, it's really hard to talk about scenarios without the actual data. It's really hard to talk about what-ifs. But we've been...
Let's imagine 25% on all of our goods.
So I can't give you any specifics in terms of data or analytics, but I can talk a little bit about the channels. Of course, let's just take, and it really depends on three key things. There's other assumptions that go into it, but there's three key things that understand. If the size of the tariffs that the U.S. would impose on our exports, and the breadth. If Canada retaliates with their own tariffs, and this third one's maybe less discussed, what do both countries do with the tariff income? Does it get recycled back to consumers and businesses, or does it go down to pay down debt? That also has an important impact on the economy. So clearly, a tariff on our exports is detrimental for our exports. So that'll have a big negative impact on economic growth in the first round effects. To the extent there's retaliation, that'll have upsetting effect on the goods we consume upwards. So there's likely to be inflation impact at the same time that we have a slowdown in the economy. So that puts a central bank in a very complicated space. Those are roughly the channels. We're going to be providing more information. But the thing is, at the end of the day, our mandate, our monetary policy mandate, will still say the same. So we'll aim to achieve our 2% inflation target, whatever comes our way. And then we'll have to manage our policy decisions after we understand exactly the details of whatever is going to be announced. But at the end of the day, to the extent that we need to target the 2% inflation rate, we'll do what we need to do to get us there.
Thank you. So we have a question here. Given you were so forthcoming with so many details, one obvious missing is a specific date for ending QT. I don't know if there's normally like a date, like is it going to be July 6th?
Well, I don't.
And notwithstanding what you just said, so maybe that's a really moving target.
I don't want to prejudge our discussions going forward up to the mid this year, but looking at a calendar, it's anywhere between now and end of June.
I hope that has satisfied the individual who asked that question. Probably
Well, there's
not.
a lot of, it's a women in capital market, or Versify, and there's a lot of people in capital markets who ask those questions all the time.
Okay. What are the implications of the timeline for normalizing the bank's asset profile for its carry profile? Did I ask that right? The P&L.
As some of you guys know, we did, coming out of QE, we had bought a lot of assets, mostly government Canada bonds. The economy was in dire straits. We tried to put the economy on a good footing and get, again, to achieve our 2% inflation target. As we did that, we bought a lot of bonds that were yielding relatively low interest rates, and our liability side is made out of currency, which luckily we don't have to pay an interest rate on that. But we also grew our reserves by quite a bit. And like I said, the reserves, we pay a deposit rate on the reserves, and that deposit rate moves one for one with our policy rate. And then coming out of the pandemic, we had a surge of inflation for a variety of reasons, which meant that we had to raise our policy rate to offset the excess demand that was in the economy. And as we raised our policy rate, means that we raised the rate that we paid on our deposits, which is a liability. So for a while, we had been losing, or not making any money, but losing money, because the assets that we hold, which are kind of fixed rate assets, bonds, the rate on that was lower than the rate that we paid on our liability. So we've lost roughly, I think, around up to $9 billion worth. Our forecast right now, given what we know about, which is based on the market's expectation of the policy rate, we should that loss is going to be cured by the year 2029, roughly. That's a forecast based on market rates, just the way things go.
Great. $9 billion.
Just to be clear,
a loss, like in Canada, that's not that bad actually. If you compare.
No, but just to be clear, I mean, our balance sheet. Just think of our balance sheet of these assets that make money, and a bunch of assets, and a slug now of a bunch of liabilities that we paid no interest on, typically. Structurally, as we normalize our balance sheet goes back to structurally always making money almost. And as we manage our balance sheet going forward, as I mentioned, any floating rate liabilities that we hold on to, in this case reserves, will be matched by floating rate assets. So again, going forward, structurally, our balance sheet is geared to only make money because of the currency in circulation.
Let's scope out a little bit, talk a little bit about employment and labor market. So employment grew in Canada in 2024, but it didn't keep pace with population growth. So what measures or policies could the bank support to encourage job creation and real wage growth in our current environment?
So just to start off with, again, our mandate is to keep inflation low and stable at 2%. And coming out of the pandemic, we had this inflation surge. And we noticed that inflation was going up in part because we had excess demand. The economy was overheating. So we raised the policy rate to slow down the economy. And since last June, we've been cutting the rate because somewhere in between that time period, the economy went into excess supply. We needed to get the economy into excess supply to cool the inflation rate. And as we've been cutting, the idea there has been to, again, try to get inflation towards our 2% inflation target. In our last communication, we mentioned that we need the economy to pick up in terms of growth to absorb that excess supply. And so we've been cutting. As the economy picks up growth, it naturally causes businesses to hire more people. The labor market picks up. Labor market gets tighter, so the unemployment rate eventually starts turning around as well. There's a little bit of lag between those two things. So we expect given that we've cut the policy rate, given that we're aiming to rebalance the economy and keep the inflation around 2%, which has been there, we expect the labor market to tighten up and improve. So that's where we see the economy going forward.
And what's the reasonable lag time that the country?
Again, it really depends. It really depends on. And the thing that's thrown a bit of a wrench is that we've had these surge in immigration, and now we have a bunch of changes that are going to see a sharp drop in immigration. So we'll have an updated NPR in a couple of weeks, and we'll have a bit more information on that going forward.
Okay. So if we look beyond sort of short-term economic stabilization, talk to us about the bank's priorities vis-a-vis some significant structural changes. We've got climate change, we've got an aging population, technology transformation. These are all seismic shifts in society and the economy. Give us a view on the bank's view on that.
So I'll start off with making clear that our mandate, our monetary policy mandate, is about getting inflation around 2%. We don't have direct responsibility for any of those mandates. They're very important to how we assess the economy. We need to understand how the economy is moving or going. We need to forecast the economy. And all those things play a big role in that. I'll take an example on climate change. Climate change has both an impact in terms of productivity going forward, if you will, but also physical climate shocks like forest fires have an impact on the economy on a kind of more day-to-day basis. And we spend a lot of time trying to understand supply shocks that affect the economy, and climate change is one of those supply shocks. Coming out of the pandemic, there was all kinds of other supply shocks, Russian war in Ukraine, logistical issues. So we've been investing a lot in our models, our forecasting models, to better understand supply shocks, and we've been kind of developing that side of our models, the supply side of our models a lot more, which is also helping us to understand, again, climate shocks, for example.
Okay. It's not an easy time. Yeah, very uncertain. I'm going to try and do this next question, Justice, but if I don't, forgive me. So how would you go to balance between off and on the run bonds?
Again, we're looking to buy assets as a business as usual process to offset currency in circulation. We'll want to buy that mix of assets that I highlighted, T-bills, term repo, and Government Canada bonds. We're buying Government Canada bonds in the secondary market. Our policy guideline will be to have the minimal market impact as possible and get the bonds we need. So we're not aiming for a specific level of liquidity. We're just trying, our aim is to, if anything, lean to improving market functioning. So that's our objective. Whether we're not trying to aim having one set of bonds more liquid than the other. That's not the case. We just want the whole market, the Government Canada bond market, to improve and be more liquid.
Okay. This is another interesting question. What really is the difference between overnight versus term repo operation? Do you think it's an efficient tool to normalize CORA?
Again, the way we implement March policy is we change the deposit rate, as I explained in my speech, which is kind of moves one for one with the policy rate. But we often see intraday, or recently it's been every day, upward pressures or downward pressures on benchmark repo rates. And when we see upward pressures on benchmark repo rates moving away from our policy rate target, we intervene by adding liquidity into the repo market, which pushes down that repo rate, overnight repo rate, back to our policy rate. If we had seen downward pressures on the benchmark repo rate, moving it below our deposit rate, below our policy rate, we would be taking out liquidity, doing reverse repos. And this is kind of a routine process that we do on a regular basis. I mean, when we start doing term repos, that might have an effect on the overnight repo rate. Dealers, for example, might be able to grab some liquidity from us and recycle that on a daily basis on the overnight rate. But it's not the intent of those operations is geared to allow us to do our normal course balance sheet management. We need assets to offset our liabilities, and that's the main objective of those term repos, but they might have a side benefit of allowing some of the dealers to use some of that liquidity that we inject by buying those assets. Basically, a 1 month and 3 month term repo is an asset to us, and it might have a positive impact on the upward pressure that we've observed on overnight repo markets.
Great. I think that puts us at time. So first of all, Tony, thank you very much for sharing insights, seeking to give us some clarity on what the bank's plans are, what your outlook is, and how we're going to get back to business as usual. And I think now the takeaway is somewhere between now and the end of June. Yep. For those who didn't hear that. As leaders in the financial sector, it's clear that kind of we all need to be attentive and alive to what you gave us today in terms of whatever clarity you could, and what we will hear from the bank going forward. This is going to be a tricky year. Maybe it's going to be a tricky 4 years. It's hard to tell. From tackling inflationary pressures to adapting to shifts in global markets. Your message today at least reinforces the importance of we have to stay focused. This is about long-term stability and growth for the country and the bank's role in that. So thank you. Again, I want to thank Xero, our partner and sponsor. Thank you for being here today. Thank you for supporting our mission and making today possible. And to everybody that came today, thank you very much for coming. This is an important conversation, and I'm glad you were all here, and I look forward to seeing all of you again as the year rolls forward. So thank you very much. Have a great afternoon.
Thank you, Tony.
Thank you very much, Tony. Thank you.